For decades, silver existed in a peculiar economic limbo, a market where true price discovery seemed impossible. While gold commanded headlines and central bank vaults, silver languished in the shadows, its price suppressed by mechanisms both visible and invisible. Traders spoke in hushed tones about something they called ghost inventory, phantom supplies that appeared whenever prices threatened to rise, mysterious sell orders that materialized from nowhere, keeping silver perpetually undervalued. This wasn't conspiracy theory. This was market structure. And for nearly 50 years, that structure held firm. But something fundamental has shifted. In a historic moment that caught even seasoned commodity analysts off guard, silver shattered through the $59 barrier, a threshold that represented not just a technical resistance level, but a psychological ceiling that had defined the metal's trading range for generations. What makes this breakthrough extraordinary isn't simply the number itself. It's what that number represents, the collapse of the old order. The ghost inventory, that endless wellspring of supply that kept silver prices anchored, has evaporated. The paper markets that once dictated silver's value are losing their grip. And for the first time in modern history, silver is entering genuine price discovery, a phase where supply and demand fundamentals, rather than financial engineering, determine its worth. To understand the magnitude of this moment, we must first grasp what ghost inventory actually was. Unlike physical shortages that traders could see in warehouse receipts or mining production reports, ghost inventory existed primarily in the derivatives market, a vast, leveraged ecosystem where paper claims on silver outnumbered actual physical metal by ratios that sometimes exceeded 100 to 1. For every ounce of real silver sitting in a vault, there were potentially hundreds of ounces represented by futures contracts, options, and exchange-traded products. This created a market where price wasn't determined by whether you could actually deliver silver, but by whether you could deliver the financial instrument that represented a claim to silver. The architecture was elegant in its deception. Large financial institutions could short-sell silver futures, betting on price declines, without ever needing to possess the physical metal. When prices rose uncomfortably high, coordinated selling in the paper market would trigger algorithmic trading systems, creating cascading sell-offs that drove prices back down. Retail investors and industrial users, seeing the price crash, would conclude that supply was abundant. The cycle would repeat. This mechanism functioned so reliably that it became embedded in market expectations. Silver's volatility was seen as a feature, not a bug. Its failure to break out despite growing industrial demand was accepted as natural. But beneath this carefully maintained equilibrium, tectonic forces were building. The global energy transition accelerated demand for silver in ways that previous industrial revolutions never had. Solar panels require significant quantities of silver for their photovoltaic cells, approximately 20 grams per panel, with that number multiplying across millions of installations worldwide. Electric vehicles contain roughly 3 times the silver of conventional cars, used in everything from electrical contacts to battery management systems. 5G infrastructure, medical devices, water purification systems, all these technologies that define the modern economy are, at their core, silver-intensive. And unlike financial speculation, this demand is structural. A solar panel manufacturer in China cannot install a silver futures contract into their production line. They need physical metal. Simultaneously, the supply side was deteriorating in ways that weren't immediately visible in official statistics. Primary silver mining, operations specifically designed to extract silver as their main product, has been declining for years. Most silver comes as a byproduct of mining other metals like zinc, lead, and copper. When those base metal prices fell during various economic slowdowns, many mines reduced production or closed entirely. The silver that came along with those operations simply stopped flowing. Exploration budgets dried up. New deposits went undiscovered. The average ore grade declined as high-quality reserves depleted. And perhaps most critically, the above-ground stockpiles that had accumulated over decades, the strategic reserves, the inherited family silver, the industrial buffers, began to drain. This drainage accelerated after 2020, when a perfect storm of monetary policy, supply chain disruptions, and inflation fears converged. Central banks worldwide unleashed unprecedented monetary stimulus, printing currency at rates that made even the most jaded observers nervous. Inflation, that supposedly dead phenomenon that economists had declared conquered, roared back with a vengeance. Real interest rates, the difference between nominal rates and inflation, plunged deep into negative territory. Suddenly, holding physical assets became not just prudent but essential. Gold captured most of the attention, but sophisticated investors remembered what history taught. Silver outperforms gold during monetary crises. The silver-to-gold ratio, which had ballooned to 120 to 1 during the 2020 panic, began its inevitable compression. Investment demand surged, but this time it manifested differently than in previous cycles. Rather than simply buying paper ETFs or futures contracts, investors increasingly demanded physical delivery. Coin and bar sales exploded. Mints around the world reported unprecedented order backlogs. Premiums over spot price, the extra cost for physical metal above the paper price, widened to levels not seen since the 1980s silver boom. This was the market sending a signal. Paper promises were no longer sufficient. The disconnect between paper pricing and physical reality was becoming impossible to ignore. The breaking point arrived not with a single dramatic event, but through a series of cascading pressures that finally overwhelmed the old system. The COMEX, the New York Commodity Exchange, where silver futures have been traded since 1933, began experiencing something it had rarely confronted: persistent delivery demands that strained its physical inventory. Traditionally, futures markets operate on the assumption that most contracts will be settled financially rather than through actual metal delivery. Traders buy and sell contracts, profiting from price movements, then close their positions before expiration. Physical delivery is the exception, not the rule. This arrangement allowed the market to function with relatively modest inventories backing enormous paper positions. But starting in late 2023, that assumption broke down. Month after month, delivery notices increased. Registered inventory, the metal actually available for delivery against futures contracts, began declining at an alarming rate. What had once been over 300 million ounces of registered silver in COMEX vaults shrank below 50 million ounces. This wasn't a temporary drawdown that would reverse when conditions normalized. This was a structural shift. The metal was leaving the exchange system entirely, flowing into private vaults, industrial stockpiles, and investment holdings where it would not return to the market at previous prices. The implications were staggering. For decades, the COMEX inventory had functioned as the backstop that made paper silver credible. When skeptics questioned whether derivatives markets truly reflected physical reality, defenders could point to those vault holdings and say, "Look, the metal is there." But as those inventories evaporated, that defense collapsed. The market suddenly confronted an uncomfortable truth. The pricing mechanism that had governed silver for generations was built on a foundation that no longer existed. The ghost inventory wasn't just declining, it was gone. And without it, the old price suppression mechanisms had lost their anchor. London faced similar pressures. The London Bullion Market Association, which oversees the professional wholesale silver market, reported persistent tightness in physical availability. Lease rates, the cost of borrowing physical silver for short-term delivery, spiked to levels indicating genuine scarcity. In normal market conditions, lease rates hover near zero because silver is abundant and lending it carries minimal risk. But when lease rates surge into double digits, it signals something profound. Holders of physical metal are unwilling to lend it out because they doubt they'll get it back or because they recognize its value will increase substantially. This is the signature of a market transitioning from surplus to shortage. Industrial users began reporting difficulties securing supply contracts. Electronics manufacturers in Asia, who had operated for decades with just-in-time delivery systems and minimal inventory buffers, suddenly found themselves competing for allocations. Solar panel producers, racing to meet renewable energy mandates, discovered that securing silver had become a constraint on production growth. This wasn't a temporary squeeze that higher prices would quickly resolve. The supply chain had been so thoroughly optimized for cost efficiency that it had eliminated all redundancy. When demand surged and supply tightened simultaneously, there was no buffer to absorb the shock. The mining industry, which should theoretically respond to higher prices by increasing production, proved unable to deliver relief in any meaningful time frame. Bringing a new silver mine online requires 7 to 10 years from discovery through permitting, construction, and ramp-up to full production. The mines that could have supplied today's market should have been started in 2015. But 2015 was a year of depressed commodity prices and mining industry retrenchment. Exploration budgets were slashed. Junior mining companies, the wildcatters who typically make new discoveries, couldn't raise capital. The pipeline of future supply simply wasn't built. And even existing mines faced challenges. Labor shortages, energy cost increases, regulatory pressures, and declining ore grades all conspired to keep production flat or declining despite rising prices. Recycling, often touted as a pressure relief valve for precious metal markets, proved inadequate. While industrial scrap recycling continued, it was already embedded in existing supply calculations. The hoped-for wave of retail selling, grandmother's silver sets returning to market, investors liquidating holdings, never materialized at scale. This marked a dramatic departure from previous cycles. In the 1980 silver peak, when prices briefly touched $50, a flood of estate silver and old jewelry swamped the market, contributing to the subsequent collapse. But this time, holders weren't selling. They had learned from history. They understood that in an era of unlimited monetary expansion and structural supply deficits, physical assets were not something to trade for paper currency. The psychological shift was complete. Against this backdrop of tightening physical markets, the paper markets began exhibiting signs of stress. Open interest in silver futures, the total number of outstanding contracts, remained elevated even as prices rose, suggesting that short sellers weren't closing positions despite mounting losses. This is classic squeeze behavior. Traders who had sold silver short, expecting prices to fall or remain range-bound, found themselves trapped. Closing their positions would require buying contracts at higher prices, potentially accelerating the rally they hoped to avoid. But maintaining those positions meant facing margin calls as prices rose, forcing them to post additional collateral to keep their trades alive. The mathematical reality was brutal. At $35 per ounce, a short position might have seemed manageable. But at $45, losses mounted. At $50, those losses became existential for some traders. And as silver blasted through $59, breaking the psychological resistance that had held for decades, the calculation changed entirely. This wasn't just another temporary spike that would reverse. This was a structural break. The market had entered a new regime, one where the old relationships no longer held, where technical analysis based on historical price ranges had become obsolete. Silver was finally, genuinely discovering its price. The $59 breakthrough represented more than a numerical milestone. It was the psychological demolition of a ceiling that had defined silver's trading behavior for over 4 decades. To understand its significance, one must revisit 1980, when silver reached its inflation-adjusted peak of approximately $150 in today's dollars during the Hunt brothers' infamous attempt to corner the market. After that spectacular collapse, silver never truly recovered its monetary prestige. It became viewed as an industrial commodity with investment characteristics, rather than as money with industrial applications. The $50 level, briefly touched in 1980 and again in 2011, became embedded in market consciousness as an insurmountable barrier, a price ceiling enforced not by fundamental constraints, but by collective memory and institutional positioning. Every approach toward $50 in subsequent decades was met with aggressive selling. Technical traders, armed with charts showing repeated rejections at that level, would short silver as it approached, creating self-fulfilling resistance. Institutional investors, burned by previous failures to break through, would take profits preemptively rather than risk another reversal. Media narratives would shift from bullish enthusiasm to cautionary skepticism the moment $50 came into view. This created a powerful feedback loop where the ceiling reinforced itself through sheer belief in its existence. The market had essentially programmed itself to reject higher prices, regardless of underlying fundamentals. But programming can be overridden when reality becomes impossible to ignore. As silver pushed through 50, then 52, then 55, something shifted in market psychology. The traders who had shorted in anticipation of another reversal found themselves squeezed. The algorithms programmed to sell at historical resistance levels found no buyers willing to absorb their offerings at those prices. The institutional caution that had characterized previous approaches to this level gave way to recognition that this time was structurally different. When silver breached $59, it wasn't just crossing a number, it was shattering a paradigm that had governed market behavior for generations. The velocity of the move accelerated as technical resistance levels fell. Markets have a peculiar characteristic. Once a major resistance level is definitively broken, it often becomes support, and price discovery accelerates into what traders call blue sky territory, price ranges with no historical reference points to anchor expectations. Silver was entering precisely this territory. Above $59, there was no modern precedent, no chart pattern to guide predictions, no institutional memory of how the metal trades at these levels. This creates conditions for explosive moves as market participants scramble to establish new valuation frameworks without the comfort of historical patterns. Central banks, which had long maintained a studied indifference to silver while carefully managing gold reserves, began reassessing their positions. While official communiques remained cautious, central bank behavior told a different story. Purchases of physical precious metals increased across emerging market central banks, with silver allocations rising alongside gold. This wasn't driven by monetary policy considerations in the traditional sense. Central banks don't use silver as reserve assets. But as stores of value in an increasingly uncertain monetary environment, both metals offered insurance against the very policies these institutions were implementing. The irony was not lost on observers. The entities creating inflation through currency expansion were simultaneously protecting themselves from it through hard asset accumulation. Geopolitical tensions added another dimension to silver's ascent. As great power competition intensified between the United States and China, supply chains became weaponized. Critical minerals and metals, once treated as fungible commodities available from global markets, suddenly acquired strategic significance. Silver's role in defense applications, from electronics and guided missiles to specialized alloys in aerospace, meant that securing reliable supply became a national security priority. Countries began building strategic reserves, removing additional metal from available supply. These purchases operated outside normal market mechanisms, with governments willing to pay substantial premiums over spot prices to guarantee delivery. The financial system itself was transforming in ways that fundamentally altered silver's role. As central bank digital currencies advanced from concept to implementation, skepticism toward purely digital monetary systems grew proportionally. The prospect of programmable money, where central authorities could control how, when, and where currency could be spent, drove renewed interest in assets beyond government control. Bitcoin captured much of this narrative, but silver offered something Bitcoin could not: physical presence, industrial utility, and thousands of years of monetary history. For those seeking to preserve wealth outside the traditional financial system without relying solely on digital solutions, silver provided the tangible alternative. Institutional investors, who had largely ignored silver in favor of gold or traditional portfolio allocations, began recognizing their exposure gap. Major pension funds, endowments, and family offices examined their portfolios and discovered they had essentially zero allocation to a metal experiencing structural deficit during a global industrial revolution. The subsequent scramble to establish positions created waves of demand that physical markets struggled to absorb. Unlike gold, where deep, liquid markets can handle billion-dollar flows with minimal disruption, silver's smaller market size meant that institutional capital had outsized impact. A single large fund deciding to allocate even 1% of assets to physical silver could absorb months of global production. Exchange-traded products designed to hold physical silver faced unprecedented inflows. Funds like SLV, which hold actual metal to back their shares, reported inventory increases that required purchasing tens of millions of ounces from already tight physical markets. This created a reinforcing cycle. Investor demand drove ETF purchases, which removed metal from available supply, which tightened physical markets, which drove prices higher, which attracted more investor attention. The cycle fed on itself, accelerating with each iteration. Unlike previous rallies driven primarily by speculation or monetary concerns, this move had the structural demand foundation to sustain momentum. Manufacturing sectors dependent on silver faced difficult strategic decisions. Electronics companies could attempt to reduce silver content through material science innovations, but such changes required extensive testing and certification, processes measured in years, not months. Solar manufacturers could lobby for subsidies to offset higher input costs, but that didn't create additional supply. Medical device producers, who use silver for its unique antimicrobial properties, had no readily available substitutes. These industrial users, collectively representing the majority of annual silver consumption, were price takers in a market where supply no longer expanded elastically with demand. Their production plans, built on assumptions of stable, available silver supplies at predictable costs, required urgent revision. The implications of silver's breakout extend far beyond commodity markets, touching the foundations of monetary policy, industrial planning, and global power dynamics. When a critical industrial metal enters price discovery after decades of suppression, it reveals uncomfortable truths about resource scarcity, financial system fragility, and the limits of paper asset substitution for physical reality. The ghost inventory that once buffered these contradictions has vanished, leaving markets, governments, and industries exposed to a repricing that will reshape economic calculations across multiple sectors. For monetary policy architects, silver's surge represents a warning signal they cannot easily dismiss. Central banks have operated for years under the assumption that unlimited currency creation poses minimal inflation risk as long as velocity remains low and expectations stay anchored. Gold's rise could be explained away as fear-driven speculation or central bank buying. But silver's industrial demand profile makes it harder to dismiss. When a metal critical to the energy transition, electronics manufacturing, and infrastructure development doubles or triples in price, it feeds directly into production costs for goods that define modern economies. Solar panels become more expensive precisely when governments are mandating their adoption. Electric vehicles face higher costs exactly as automakers commit billions to electrification. The inflation that central banks insisted was transitory acquires a structural, supply-driven component that monetary policy cannot address. The energy transition, that grand project to decarbonize the global economy, now confronts a resource constraint that threatens its ambitious timelines. Policymakers and climate activists have focused intensely on lithium, cobalt, and rare earths, the materials that garnered headlines and drove mining company valuations. Silver received comparatively little attention despite being equally critical. A typical solar installation might use relatively small amounts per panel, but multiply that across the terawatts of capacity required to meet net zero targets and the numbers become staggering. Current annual silver production totals approximately 1 billion ounces. Solar installations alone could eventually require several hundred million ounces annually if deployment continues accelerating. Add electric vehicles, 5G networks, and other silver-intensive technologies, and the mathematics become problematic. Substitution, that economic mechanism that theoretically resolves commodity shortages, proves elusive with silver. Material scientists have explored alternatives for decades, achieving modest reductions in silver loading for some applications, but finding complete substitution technically difficult or economically unviable. Silver's unique combination of electrical conductivity, thermal conductivity, reflectivity, and antimicrobial properties makes it functionally irreplaceable in many uses.
Copper offers lower cost but inferior performance. Aluminum provides lighter weight but inadequate conductivity for critical applications. Synthetic materials can mimic some properties but not the complete package. The reality is that modern technology was developed around silver's specific characteristics, and redesigning fundamental processes to eliminate it would require time and investment that don't align with the urgent timelines driving industrial transformation. Mining companies, which should be celebrating higher prices, instead face a complex landscape of challenges that prevent rapid supply response. Permitting a new mine in developed countries now routinely takes a decade or longer, with environmental reviews, community consultations, legal challenges, and regulatory approvals creating obstacle courses that many projects cannot navigate successfully. Capital costs have soared as labor, equipment, and energy expenses all increased. The industry also faces a demographic crisis. Experienced mining engineers are aging out of the workforce faster than younger professionals are entering it. Universities have reduced or eliminated mining programs as student interest declined during the long commodity bear market. The expertise required to find, develop, and operate mines efficiently is literally retiring, taking decades of accumulated knowledge with it. Geopolitically, silver's emergence as a constraint creates new leverage points and vulnerabilities. China dominates solar panel manufacturing and has secured strategic positions across global silver supply chains through investments in mining operations, refining capacity, and downstream processing. This vertical integration provides Beijing with influence over a market that Western economies increasingly depend upon for their industrial and technological ambitions. The United States and Europe, having largely abandoned domestic silver production and refining over decades of offshoring, now find themselves dependent on supply chains they don't control for a material they cannot substitute. This echoes the rare earth dependency that only recently gained policy attention, but silver's broader industrial applications make the strategic implications even more significant. Financial markets are still processing what genuine price discovery means for silver. Derivative pricing models built on historical volatility and correlation assumptions no longer function reliably when the underlying market structure has transformed. Options pricing becomes guesswork when there's no historical precedent for current price ranges. Risk management systems calibrated for mean reversion struggle to adapt to trending markets with structural drivers. Hedge funds and commodity trading advisors who profited from silver's range-bound behavior now face a market that has broken free from those constraints. Some will adapt, repositioning from the short side to the long side or developing new strategies for the emerging regime. Others will face catastrophic losses as positions built for one market environment encounter a fundamentally different reality. The breakdown of the silver-to-gold ratio tells its own story. Historically, this ratio has fluctuated between 15 to 1 and 100 to 1, with long-term averages around 60 to 1. During the 2020 panic, it briefly exceeded 120 to 1, representing extreme undervaluation of silver relative to gold. As silver breached $59, while gold traded around $3,200, the ratio compressed to approximately 54 to 1, approaching historical averages but still leaving substantial room for further compression if historical patterns reassert themselves. Some analysts argue that given silver's industrial demand growth and supply constraints, the ratio should compress to 30 to 1 or even lower, levels that would imply dramatically higher silver prices even if gold remains stable. Whether such extreme compression occurs depends on factors that remain uncertain, but the direction of travel appears clear. What happens next depends on variables that interact in complex, non-linear ways. If industrial demand continues accelerating while mine production stagnates, prices could rise substantially further, potentially approaching or exceeding inflation-adjusted all-time highs. If higher prices eventually incentivize enough new production or demand destruction to restore balance, a new equilibrium might establish at elevated but stable levels. If financial system stress intensifies and investors flood into physical precious metals, silver could experience a momentum-driven spike that overshoots fundamental values before correcting. If technological breakthroughs enable successful substitution at scale, industrial demand could decline, easing pressure. Each scenario has proponents and supporting evidence. What cannot be disputed is that the old regime, the era of ghost inventory, of paper price suppression, of silver trading in a predictable range, has ended. The market that existed from 1980 through 2024, where silver repeatedly approached but never definitively broke through resistance, where supply always seemed to materialize when needed, where prices could be managed through futures market operations, that market is gone. Silver has entered price discovery, a phase where fundamental supply and demand dynamics, rather than financial engineering and historical patterns, determine value. The journey from here is uncharted territory, moving through price ranges that have no modern precedent, guided only by the mathematics of supply constraints meeting accelerating demand. The ghost inventory is gone. What comes next will be determined by physical reality, not paper promises. And that reality, increasingly evident with each passing quarter of tightening supply and rising industrial consumption, points towards a repricing of silver that may ultimately dwarf what we have witnessed so far. The breakthrough past 59 was not the destination. It was merely the beginning of a journey into genuinely unknown territory, the terra incognita of true price discovery in a market that has finally broken free from its chains.